Best Buy has been hammered all year, down 22% year to date. It is trading right at its 52-week low, offering a very nice starting yield of just under 6%. Now, is this company undervalued? Can we look to buy Best Buy at an incredibly cheap price and see our yield on cost grow to double digits, 10, 11, 12% over the next few years? We're going to take a look at the historical performance of Best Buy. We're going to look at their revenues, their net income growth over the last 5 years. We're going to look at their balance sheet, take a very quick snapshot of their health check, total cash versus total debt. We're going to also compare them to some of their competitors in the computer and electronic retail section, looking at their total return performance over the last 5 years. And as always, we want to have a quick look, see what are the institutions doing. Are they buying or selling? And we will also look at some very important dividend and financial metrics of Best Buy that you need to be aware of before investing in this company. And as always, we will put it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given our investor margin of safety. Now, down 22% year to date. If we look at the last 10 years, investors who have been holding this position would be up around 48%. Remember, it doesn't include those dividends reinvested. And we can see it did peak towards the end of 2021 at around $137. So it will be interesting. Is this a stock that can go back even higher than its 52-week high and even higher than we saw its all-time high over the last 10 years, meaning it will be 3 times, 4 times higher than the current trading price. So that will be interesting to see. So let's take a look in today's episode. So in terms of the top line growth, what we like to see with revenues is 3 to 7% minimum year on year. February 2019, 43 billion reported on the top line. January 23, 46 billion. So not massive growth over the last 5 years, around 10%, and that isn't really what we want to see from a company. But on a more granular level, what we see in fact is there was some growth from 2019 to 2022, and then it did in fact drop quite considerably. So there is one thing to note, this company was growing from 2019 to 22 before dropping. Now we do see the trailing 12 months looking around 44 billion, so it will be interesting to see the seasonality of this business if they do pull out strong, and we do see essentially a very nice increase from January 2024. Now taking a look at the bottom line net income, 1.4 billion reported in 2019, 1.4 billion in 2023. So that net income has remained for the large part relatively flat over that 5 years. And on a more granular level, we do in fact see a very similar to the top line revenue, an increase from 2019 to 2022 before then dropping down in 2023. Likewise, with the trailing 12 months, we do also see that around that 2023 level. So again, with seasonality of the business that I would expect, with Christmas coming and people looking to buy lots of items, I would expect this to be at least in line with the prior year, which isn't really what we want to see. We do want to see growing revenues and bottom line. Now, when we take a look at the quick health check of the company, balance sheet, the total cash versus total debt, February 2019, 2.1 billion of cash and short-term investments. Latest quarterly report, they are holding less cash than they did 5 years ago at 1.3 billion. Now total debt, as always, we take a look at that movement directionally numerically. 1.4 billion of total debt in 2019, around 4 billion in their latest report. So quite a significant increase over the last 5 years. But that is a bit worrying given their cash position did drop. But given there aren't large differences, we can take a look at that net debt to EBITDA figure to take a look and see how safe that dividend is. Now, in terms of comparing it to some of their competitors, we do have GameStop, Upbound Group, and a few others. On a total return year to date, including those dividends reinvested, Best Buy is down at 19%, which is very poor. And interestingly, it is one of the best performers of their peers. So it does tell you as a whole the industry has been hit this year. Now, when we expand our time horizon to the last 5 years, for Best Buy, we can see it is up 10.22%, and it is in the middle of its peers. But as always, remember, we're not looking at past performance as an indicator of the future. It is just that one level that we do extra. Now, institutional ownerships, around 76% of institutional ownership as we see here. 2 billion worth of shares sold over the last 12 months, 2.6 billion bought. Interestingly, though, what we do see over the last few years, if in fact nearly every single year, more buying by institutions than selling quarter over quarter. So it does look over the long haul, institutions are buying more shares than they are selling of this company. But remember, we're not copying what institutions are doing, and we are doing our own due diligence. Now, taking a look at their financial metrics, we see straight away a dividend safety score of 80, making it safe, and a market cap of 13.7 billion, so it is a large cap company. Now, for those that see a recession inbound very soon, well, they increased their dividend during the last 07-09 recession. They had positive sales, plus 5.6%. Remember, the average growth of companies in the S&P 500 during the recession was in fact negative growth, so this is a positive sign. But then we do see their recession return at negative 49%, which isn't too far off the S&P's negative 55%. So something just to digest for those viewers that do see a recession incoming. So an increase of 4.5% this year in March, not bad. It is in line with inflation, as I always advocate on the channel, a minimum of 4%. Last 5 years, double digits, very strong, 19%. Last 10 years on average, 18%, again double digits. So very positive to see the track record of the dividends paid, but just a little bit disappointed in that average inflation rate increase this year. They've also been paying increasing dividends over the last 19 years, which is always positive to see. And dividend yield theory showing that it is severely undervalued at 5.84%, given it is above the 5-year average yield of 2.89%. But remember, we're not looking at any of these models in isolation. Forward PE 9.6 versus 12.6, another sign of undervaluation, as well as the sector PE being significantly higher than that of Best Buy at 9.6, sitting at 12.5. Now, it is at the 52-week low, but remember, 52-week low is not a signal for undervaluation. Likewise, a signal for overvaluation is not the 52-week high. As always, investors that love to look at the earnings, data is always there. It is susceptible to manipulation by management through accounting, so I do focus your attention on the free cash flow. Below 60% is what I like to see. What we can see for the large part, in fact, it has been below that 60%. 2023 coming in unusually high given their track record, but 24 expected to come down to 62%. So that does give me faith that this is one of the reasons why we did in fact see that subpar dividend increase for this company at 4%. And in 2024, we should expect to see a double-digit increase considering the business itself is being positively run. Now, free cash flow per share, 160 in 2014, 398 in 2023. Now, that is a very nice increase. I mean, it's more than double over the last 10 years. But interestingly, we did see it top up at 1620 in 2021 before coming down. So it would be nice to see it go back up to the levels that we have historically seen. And 2023, it is expected to go up to around $6. So that is positive for this company, which has been hammered down quite a lot recently. Now, sales growth 3 to 7% is what we like to see. Unfortunately, for nearly half of the last 10 years, they have had negative growth, which isn't really what you want to see in any kind of company you're investing in. And numerically speaking, only a real 10% increase of sales over that last 10 years from 41 billion to 46. So you could argue it's not really keeping up with inflation at 4% a year. So in real terms, the revenue is relatively flat. Shares outstanding, we love it when investors do share buybacks, 348 million in 2014, 226 in 2023. So the company is returning excess cash to shareholder pocket, which is positive to see as an investor. Now, ROIC, some phenomenal figures here. Now we look at 10% or more. The reason for this, it gives me faith that management are able to effectively allocate their capital. Above, in fact, 20% every single year, with the last few years seeing some very, very nice digits. So that is very positive to see. It is a good sign of management, in my opinion. Now, operating margin, free cash flow margin, this is a bit of a worry. Consistently, it has been below both the free cash flow and operating margin. You would like to see the operating margin higher. It does then mean the bottom line, in theory, should be higher, which means more dividends paid out at a larger increase. So a slight, I wouldn't say a red flag, it is just typical of this company and the consistency we can see around 4 to 5%. Likewise, on that free cash flow margin, it is always good to understand what type of company you're buying into. Now, net debt to earnings before interest, tax, depreciation, and amortization, it is something that is correlated to that dividend safety, showing us the number of years it take the company to pay off their debt net of cash on hand. Below 3 is what we look for, 2023 at 0.49, 2024 expected 0.71, still well below that 3 that we look for as a maximum, and hence why we do effectively see that dividend safety score. So far there has been quite a lot of positives, a few red flag indicators that you should just bear in mind. And as always, we're going to run it through our valuation model. And don't forget, if you are enjoying the content, value is being provided, do hit that like button, do subscribe and hit the bell to be continually notified of these videos. And as always, if you want to grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. Starting off with Graham's valuation, we have the stock ticker at BBY, the earnings per share, the growth rate panelist estimates, and that current yield on AAA corporate bonds. Now, the intrinsic value is coming to $58, and when we take a look at the current price, it's a few dollars short of what is the current market value. So you could argue reasonable valuation / some signs of overvaluation. However, as always, remember we aren't looking at any model in isolation and drawing our conclusions towards the end. Now, the second model that we typically use is the multiples valuation model. However, a lot of the companies that we did analyze in the 5-year total return did in fact have negative earnings per share, and therefore it was difficult to use any of them to compare to this company. So in today's episode for Best Buy, we will not be using this model. We then move on to the second model. We will be using the dividend discount model, where we see some very nice dividend growths over the period, on average around 16%. Now, forward looking, I've gone slightly higher than the recent increase that we saw, but it is lower than the average growth rate. So you can argue as an investor whether it should be higher or lower. You can just grab a copy of the model and play around with the percentages based on your own investment thesis. So this gives a DDM price of $129. As we can see, significantly higher than the current trading price, around double the current trading price, in fact, and above that 52-week high, showing signs of undervaluation in the current market. We then move on to the DCF model with our free cash flows year on year. Average growth rate around 34.5%. Now, forward looking, analysts estimating 4%. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, arrive at the equity value, divide by the shares outstanding to give a DCF price of $73. Now, when we take a look at the market value, that is still showing signs of undervaluation, higher than the current trading price, but within that 52-week range. So now we get to the intrinsic value, and don't forget, this is just the average of the models that we have just run through. And as always, if you are enjoying the content, value is being provided, do hit that like button, do subscribe, and hit the bell to be continually notified of these videos. Now, 10% margin of safety is what I would start with if you believe it has a wide moat, strong financial metrics, good forward-looking data. Now, you can argue with this at a minimum you want 15%, which means a buy up to $73. For those looking at 20%, it would be a buy up to $69. And those looking at 25%, a buy up to $64. So right now, if you do run through the estimates and judgments that we have just gone through, this is a margin of safety of 25% up to $64, $65. Those looking at 30%, it would be a buy at around $60. And as we can take a look, that is slightly lower than the 52-week low seen not too long ago. Now, what do Wall Street say? Well, Wall Street believe there to be some very strong upside to the current price, nearly at our intrinsic value at $82.60. So they do believe that Best Buy is a strong buy, in fact. But remember, we always do our own due diligence and don't copy whether it's the analysts at Wall Street or the institutions. As always, let me know your thoughts in the comments below. I'm especially intrigued here if Best Buy is one of those value plays you're looking to add to your portfolio, or if you're someone who has recently sold this. Now, don't forget, hit that like button if you are enjoying the content. Value is continually being provided. Do subscribe and hit the bell if you want to be continually updated with these videos on your doorstep. And don't forget, if you want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio and acceptable buy price, then click on that pinned comment below. Finally, if you do want to join us in the Discord talking all buyers and sells in the market, then do click on the Patreon link too. As always, have a great day. Catch you on the next episode and take care.